There's a pattern in economic history that repeats itself with almost mechanical precision. Not every decade, not randomly, but whenever certain conditions align. Sky-high asset prices, record-breaking debt, extreme leverage, and a widespread belief that this time is different. Then comes a trigger, some event that forces forced selling, and the dominoes fall. These exact conditions existed in 1929. They were present in 2008, and today, in 2025, they're all here again. Not similar conditions, identical ones. The stage is set, the players are in position, and if history is any guide, the next crash could hit in late 2026 or early 2027. This isn't prophecy, it isn't fear-mongering, it's pattern recognition. I'm going to walk you through how crashes unfold, who loses everything, who profits massively, and why the coming crash could be far worse than 1929 and 2008 combined. Why? Because the scale is bigger, leverage is higher, the financial system is more interconnected, and policymakers have already spent almost all of their ammunition fighting the last crisis, leaving almost nothing in reserve for the next one. What follows is a documentary-style analysis of a crash that hasn't happened yet, but follows a script that has repeated twice before, with devastating accuracy. The mechanics are the same. The timeline is predictable. The winners and losers? They always followed the same pattern. Let's start with the present, January 2025. Every crash begins with a bubble. And right now, we're living through the largest everything bubble in history. Not just stocks. Real estate in major cities has never been more expensive. The median home price in the U.S. is $420,000, while the median household income is $75,000. That's a ratio of 5.6 to 1. Historically, a sustainable ratio is around 3 to 1. At 5.6, housing is overvalued by 87% compared to incomes. For comparison, in 2006, just before the housing collapse, that ratio peaked around 5.0. Corporate debt has never been higher. Non-financial U.S. corporate debt sits at $13.5 trillion, 72% of GDP. In 2007, it was only 43%. Companies are more leveraged today than they were before the last crash. Government debt? $36 trillion, 120% of GDP, with interest payments alone nearing $1 trillion per year. Consumer debt, including credit cards, auto loans, and student loans, totals over $17 trillion. Add it all up, government, corporate, household, and financial sector, and total U.S. debt exceeds $90 trillion. That's more than 320% of GDP. Every sector is stretched beyond historical norms. Everything is expensive, everyone is in debt, and everyone believes prices will keep rising forever. Why do they believe this? Because the Federal Reserve has been their safety net for 15 years. Since 2009, whenever markets stumbled, the Fed cut rates or printed money. QE1, QE2, QE3, COVID stimulus, the Fed printed over $8 trillion from 2008 to 2022. That money flowed into assets, driving prices higher. Investors learned one lesson: buy the dip. The Fed will save you. But here's the problem. The Fed has used up its ammo. Interest rates were near zero for a decade. The balance sheet expanded from $800 billion in 2008 to $9 trillion in 2022. There's little room left to maneuver without triggering inflation, which already spiked in 2021 to 2022. The Fed responded by raising rates from 0% to 5.5% in just 18 months, the fastest increase in 40 years.
This tamed inflation, but created new problems. Debt that was cheap at 3% now costs 7%. Mortgages, corporate loans, everything is more expensive. The burden is crushing, and the Fed can't lower rates much without reigniting inflation. They're trapped. Too low, inflation returns. Too high, debt becomes unpayable. There's no easy path forward. This is the setup. Peak valuations, peak leverage, and a Fed that has already spent its firepower. Now, let's see how this mirrors 1929 and 2008, because the patterns are strikingly similar. In 1929, the stock market soared 400% between 1924 and 1929. Margin debt, borrowing to buy stocks, hit 10% of GDP. Everyone was leveraged. Everyone believed prices could only rise. Economists even used the phrase permanently high plateau to describe a new era where crashes were supposedly impossible. Then October hit. Over 3 years, the market fell 89%. In 2008, the housing market doubled from 2000 to 2006. Mortgage debt reached 100% of GDP. Everyone was leveraged, buying homes with subprime loans. The prevailing belief? Housing prices could never fall nationwide. Then the defaults began. Subprime mortgages started failing and the financial system collapsed. The S&P 500 fell 57%. The setup was the same in both cases. An asset bubble, extreme leverage, widespread confidence that prices could only rise, a trigger, and then cascading liquidations. The 2026 crash is likely to follow the same script. We have the bubble, we have the leverage, we have the illusion that Fed intervention makes crashes impossible. All that remains is the trigger, and there are several candidates. Let's look at the 3 most likely ones and how each could set off the chain reaction. Trigger 1. Commercial real estate collapse. This is the most probable because it's already in motion. Office buildings across the U.S. sit 40 to 50% vacant thanks to remote work. Companies that once leased 5 floors now lease 2. This change is permanent. Remote work isn't returning to pre-2019 levels. These buildings were financed with mortgages at 3% interest. Those loans are maturing now and must be refinanced at 7 to 8%. A building that barely covered its mortgage at 3% is bankrupt at 7%. Owners are walking away. Brookfield Asset Management, one of the world's largest real estate holders, defaulted on 2 office towers in Los Angeles in 2023, handing the buildings back to lenders. This wasn't because Brookfield is failing. Those specific properties are worth less than the debt. It's economically rational. Between 2025 and 2027, over $2 trillion in commercial mortgages will mature. Even a 30% default rate would mean $600 billion in losses. Who holds these loans? Regional banks. Community and regional banks often have 20 to 40% of their loan portfolios in commercial real estate. Defaults erode capital. When banks fall below regulatory minimums, regulators shut them down. We've already seen this pattern begin. Silicon Valley Bank collapsed in March 2023. Signature Bank failed the same week. First Republic followed in May. While high interest rates were blamed, the underlying problem was commercial real estate. If defaults continue through 2025-2026, 50 to 100 regional banks could fail, triggering panic. Trigger 2. Major corporate bankruptcy or sovereign debt default. Hundreds of companies borrowed at low rates in 2020-2021. Now they must refinance at double or triple the cost. Some won't manage. If a Fortune 500 company defaults on its bonds, panic spreads. Investors sell other corporate bonds, yields spike, refinancing freezes, and more companies default. A contagion effect. This was exactly how 2008 escalated. Lehman Brothers fell, and suddenly everyone feared the next collapse. Credit markets froze. Sovereign debt works the same way, but on a larger scale. If an emerging market, Turkey, Argentina, Pakistan, defaults on dollar-denominated debt, investors question other countries' ability to pay. Bonds sell off, currencies crash, defaults multiply. Banks that lent to these nations, often in Europe or the US, take losses. Contagion spreads globally. One default can trigger a chain reaction. Trigger 3. Geopolitical shock. War, pandemic, terrorism, or political upheaval can spike volatility and force asset sales. The March 2020 COVID crash was exactly this type of trigger. Initially, the pandemic wasn't an economic problem. It was a health crisis, but the uncertainty triggered a massive flight to cash. A similar shock? Conflict over Taiwan, Middle East oil disruptions, a violent contested U.S. election could spark the same rapid liquidation. Any of these three triggers could ignite the cascade, but the root cause remains the same: excessive valuations and leverage. The trigger is just the spark. Once selling begins, the mechanics take over, and they're brutal, predictable, and devastating. Here's how it unfolds based on patterns from 1929 and 2008. The speed may vary, but the sequence is consistent. Phase 1. The initial shock. The trigger hits. Markets drop 10 to 15% in days. Investors are surprised, but not yet panicked. They see a buy-the-dip opportunity. The Fed will step in, right? Stocks are on sale. Analysts tell the media fundamentals are solid and the setback is temporary. In 1929, the first shock came on October 24th, Black Thursday. Stocks fell 11% in a single day. Panic, but not catastrophe. Bankers met and promised support. Prices recovered slightly, and everyone believed the worst was over. In 2008, the first shock came in March when Bear Stearns collapsed. The market fell 15%. The Fed quickly arranged a bailout, and J.P. Morgan acquired Bear Stearns. Crisis averted, or so it seemed. In 2026, the initial jolt could be a major bank failure or a wave of corporate defaults. Markets drop 10 to 15%. The Fed issues statements: "We are monitoring the situation, the financial system is strong, liquidity is available." Investors see an opportunity, buy the dip, and stocks recover partially. But the seed of doubt has been planted. Confidence is cracked. Phase 2. The false recovery. After the initial shock, markets often stabilize or even rise. This phase can last weeks or months and is extremely dangerous because it lulls investors into a false sense of security. In 1929, after Black Thursday, the market rebounded for a week. By early November, stocks were nearly back to pre-crash levels. Those who sold early felt foolish. Those buying the dip felt vindicated. Then November 11th hit. The market plunged 13% in a single day. The real crash had begun.
In 2008, following Bear Stearns' collapse, markets stabilized through spring and summer. By July, the S&P 500 was only down 10% from its 2007 peak. Analysts declared the bottom, claiming the crisis was contained. Then September came. Lehman Brothers failed. The S&P plunged 40% in 6 weeks. In 2026, the false recovery could last 3 to 6 months. Initial failures are blamed on isolated mismanagement, not the broader economy. The Fed cuts rates modestly. Markets rally. Investors breathe easy. But the underlying problems continue spreading. Phase 3. The cascade. This is when the real crash hits. Forced liquidation, margin calls, panic selling all accelerate downward. In 1929, the cascade lasted from November 1929 to July 1932, with the market losing 89%. In 2008, it was faster. September 2008 to March 2009, a 57% drop. In 2026, the cascade could span 12 to 18 months, with the S&P potentially dropping 50 to 70% from peak to trough. How the cascade works? Margin calls. Leveraged investors are forced to sell. Borrowed at 50% margin, a 20% drop wipes out their equity. Brokers force sales, driving prices down further. Redemptions. Mutual funds, hedge funds, and pension funds face withdrawals. They sell assets to meet demands, adding more selling pressure. Algorithmic amplification.
High-frequency trading sees falling prices and accelerates selling. Stop-loss triggers. Circuit breakers halt trading, but panic spreads. Liquidity vanishes. With everyone selling and no buyers, stocks gap down 10 to 30%. The market collapses. Credit freezes. Banks stop lending as defaults rise. Companies cannot refinance debt, leading to more defaults and bank losses, a vicious cycle. During the cascade, the economy slides into recession. Stock market crashes destroy trillions in wealth. Consumers cut spending, companies lose revenue, layoffs rise, unemployment jumps from 4% to 9 to 10%, fueling a feedback loop that deepens the downturn. Phase 4. Maximum panic. This is the ultimate low point. Fear so extreme that people sell everything regardless of price. 1929, July 1932, Dow at 41, down 89%, unemployment 25%, hundreds of banks failed. 2008, March 2009, S&P 500 at 666, down 57%, unemployment 10%, major banks insolvent and bailed out. In 2026-2027, the panic bottom could arrive late 2027 or early 2028. The S&P, currently around 6,000, could fall to 2,000 or lower. Unemployment could reach 10%, multiple bank failures, and government intervention will be inevitable. Maximum fear, but also maximum opportunity. Phase 5. The slow recovery. Recovery begins when massive government intervention restores confidence. 1933, Roosevelt's New Deal, job creation, banking reforms. Stocks didn't recover to 1929 levels until 1954, 25 years later. 2008, Fed printed $3 trillion, Congress passed stimulus. Stocks reached new highs by 2013, full economic recovery by 2015. In 2026-2027, intervention will be on a larger scale. The Fed will slash rates to zero. Congress will likely pass multi-trillion-dollar stimulus. Recovery will follow, but the scars will run deep, and wealth will have shifted dramatically. Banks will likely be bailed out, but the recovery could be slower than in 2008 because debt levels are even higher. Government debt is already at 120% of GDP. Adding trillions more in stimulus could push it to 150 or even 180%. At these levels, debt service consumes a huge portion of tax revenue. The government will face difficult choices: austerity, higher taxes, or trying to inflate the debt away. None are easy. The recovery could take 5 to 10 years. Stocks may not reach 2025 levels again until 2032 or later.
This is the 5-phase pattern: initial shock, false recovery, cascade, panic bottom, and slow recovery. Now, let's talk about the wealth transfer, the people who lose everything versus those who profit massively. Every crash redistributes wealth from the unprepared to the prepared. Who gets destroyed? The middle class, holding stocks and homes, takes the hardest hit. In 1929, middle-class investors lost everything. Families that felt wealthy in 1928 were destitute by 1933. Stock portfolios fell 89%, and homes were foreclosed. In 2008, middle-class homeowners who bought near the peak lost 40 to 50% of home equity. Many went underwater, owing more on mortgages than their homes were worth. Some walked away. Others were foreclosed. In 2026, it's the same story. Middle-class families with $41,000 retirement accounts could see them fall 50 to 70%. A $500,000 retirement account might shrink to $200,000. Homeowners who bought recently at peak prices may see values drop 30 to 50%. A $600,000 home could fall to $400,000 or less. Retirees are devastated. Small business owners will also suffer. When consumers cut spending, businesses lose revenue, can't pay rent or employees, and go bankrupt. In 2008, 170,000 small businesses closed. In 2026, the number could be higher. Restaurants, retail stores, and service businesses disappear. Owners lose everything: savings, businesses, even homes used as collateral. Leveraged investors are wiped out. Anyone who borrowed to invest, margin debt, mortgages to buy rental properties, faces margin calls and forced liquidation at the worst possible prices. They don't just lose their investments, they lose more than they put in, crushing credit in financial futures. Who profits? Every crash creates enormous wealth for those prepared. In 1929, Joseph Kennedy made $50 million by shorting stocks. Bernard Baruch hoarded cash and gold, buying assets at depressed prices. In 2008, John Paulson made $20 billion betting against subprime mortgages. Michael Burry made $700 million. Warren Buffett bought Goldman Sachs and Bank of America at crisis prices, making billions. In 2026, the same playbook will create the next generation of billionaires. Who profits? Cash holders. Investors who sell before the crash and hold cash or treasury bills preserve capital while stocks fall 60%. At the bottom, they deploy cash to buy stocks at 40 cents on the dollar, foreclosed real estate at 50% of peak price, and businesses being liquidated. Warren Buffett, holding $325 billion in cash in 2024, could deploy it at unprecedented scale. Short sellers, investors betting against overvalued stocks, sectors, and markets. In 2026, targets could include commercial real estate, regional banks, and over-leveraged corporations. Short a bank at $50 and watch it drop to $5, a $45 gain per share. Hedge funds building these positions now could make billions, repeating the strategies of 2008. Gold holders. Gold benefits when currencies devalue. In 1929, gold was fixed at $20 per ounce, then revalued to $35 in 1934, a 69% gain. In 2008, gold rose from $800 to $11,900 by 2011, a 137% gain. In 2026, gold could move from $2,700 to $5,000 or more as the Fed prints trillions, devaluing the dollar while gold remains finite. In every crash, the same lesson holds. Those who anticipate the pattern and act early prosper, while those who don't lose everything. The 2026 crash will be no different, only larger in scale and more brutal in speed. Distressed debt buyers profit massively during crashes. When companies go bankrupt, their debt trades at 10 to 30 cents on the dollar. Vulture funds swoop in, buy the debt, wait for restructuring, and collect 50 to 100 cents. A $100 million investment can become $300 million. Carl Icahn, Howard Marks, Oaktree Capital, they all made fortunes buying distressed debt in 2008. They'll do it again. Real estate investors with cash also thrive. When foreclosures spike, properties sell at auction for 40 to 60% of value. Investors with ready capital buy entire portfolios, rent them out, and wait for the market to recover before selling at huge profits. Blackstone, for example, bought 80,000 homes between 2009 and 2012 at depressed prices and made billions. Private equity firms are already holding trillions in dry powder, ready to deploy. When the crash comes, they'll buy companies being liquidated, divisions of corporations needing cash, and other assets at 30 to 50 cents on the dollar. Hold them through the recovery, sell at full price, and create generational wealth. This is the wealth transfer from middle-class families holding stocks and homes to elite investors who positioned themselves before, shorted during, and bought at the bottom. It's not theft or illegal. It's understanding the cycle. Crashes don't destroy wealth. They move it from those unprepared to those who are. Comparing 2026 to 1929 and 2008, what's the same? Bubble mechanics. All three began with asset prices disconnected from fundamentals. 1929, stocks at 30 times earnings. 2008, homes at 5 times median incomes. 2026, everything at record valuations simultaneously. Leverage. 1929, margin debt. 2008, subprime mortgages. 2026, corporate, consumer, and government debt, all at historic highs. Belief in permanence. This time is different.
1929, permanently high plateau. 2008, housing never falls nationally. 2026, the Fed won't let markets crash. Every bubble thinks it's different, it's never true. Cascade mechanics. Forced liquidation triggers more liquidation. Credit freezes, panic selling. Mechanical, not emotional. Once leverage hits critical levels, any trigger starts the cascade. Wealth transfer. Cash holders, gold owners, and short sellers profit. The fully invested and leveraged lose everything. This pattern hasn't changed in a century. What's different? Scale. 1929, U.S. market capitalization, $80 billion. 2008, $12 trillion. 2026, $50 trillion. 4 times larger than 2008. Losses could reach $30 trillion. Speed. 1929 took 3 years to bottom. 2008, 6 months. 2026 could be faster. Algorithmic trading, global interconnection, and instant information. The crash could occur in weeks. Global interconnection. 1929 was mostly U.S., spreading slowly to Europe. 2008 was global, but emerging markets recovered quickly. 2026, fully global. China, Europe, and emerging markets all interconnected. A crash in one region spreads instantly. No safe haven. Government capacity. 1929, initial inaction. 2008, the Fed had room to cut rates, fiscal space to spend. 2026, rates already low. Debt at 120% of GDP, balance sheet massive. Government response will be large but less effective. Social consequences. 1929, political extremism, fascism, communism rise. 2008, Occupy Wall Street, Tea Party, polarization. 2026, extreme wealth inequality, hollowed middle class. A crash could spark revolutionary political instability. Timeline, pattern-based projection, not exact dates. Early 2025, current state. Markets at all-time highs, valuations extreme, leverage at records, investors trust the Fed to prevent crashes.
Mid-2025, early 2026. Trigger event. Bank failures, corporate bankruptcy, or geopolitical shock. Markets drop 10 to 15%. Phase 1, initial shock. Spring 2026, the false recovery. Markets stabilize or even rise slightly. Media declares the crisis over. Investors buy the dip. But beneath the surface, problems are spreading. Summer to fall 2026, the cascade begins. Defaults accelerate. Credit freezes. Markets enter freefall. By the fall, stocks could fall 50% over 6 to 9 months. Late 2026 to mid-2027, the panic bottom. Unemployment spikes to 10%. Banks fail. Government intervention kicks in. The Fed cuts rates to 0. Congress passes massive stimulus. This is the moment of maximum fear and maximum opportunity. Late 2027 to 2030, slow recovery. Markets stabilize and gradually rise. The economy recovers. Unemployment falls. But stocks may not return to 2025 levels until 2030 or later. The exact timing could shift by months, but the sequence is inevitable. History shows the crash will hit late 2026 or 2027. The pattern has been correct twice before. What should you do with this information? This is not financial advice. I'm not a financial advisor. But pattern recognition suggests strategies that worked in 1929 and 2008. Reduce stock exposure. If you're fully invested, consider lowering to 50 to 60%. Hold the rest in cash or treasury bills. You'll miss some gains if markets rise, but you'll preserve capital when they crash. Hold gold.
5 to 10% of your portfolio in physical gold or ETFs. When the Fed prints money during the crash, gold gains purchasing power. Identify quality companies. Make a list of businesses with strong balance sheets and low debt. Apple, Microsoft, Berkshire Hathaway, Visa, Johnson & Johnson. When the crash hits and prices drop 50%, buy them. Prepare psychologically. The hardest part isn't strategy, it's courage. Buying during maximum fear is terrifying. In March 2009, it felt like the world was ending, but fortunes were made. Mentally prepare now to act then. Protect your income. Make yourself indispensable at work. Reduce personal debt. Build an emergency fund. If layoffs come during the crash, savings keep you afloat. Watch indicators. Commercial real estate defaults, regional bank stocks, high-yield bond spreads. These signal when the cascade is beginning. When they deteriorate, it's time to get defensive. The 2026 crash isn't guaranteed. Perhaps the Fed engineers a soft landing, valuations normalize gradually, or leverage unwinds slowly. But the pattern says otherwise. Twice before, when conditions aligned like they do now, crashes followed. Devastating events that destroyed the unprepared and enriched those who saw it coming. The setup is complete. The bubble is inflated. Leverage is extreme. Belief in permanence is universal. We're waiting for the trigger. When it comes, the 5-phase pattern will play out. Initial shock, false recovery, cascade, panic bottom, slow recovery. Wealth will transfer from the middle class to those positioned correctly. Lives will be ruined, fortunes created. In 10 years, economists will write papers asking why no one saw it coming. Yet the pattern was obvious. If this documentary has shown you a pattern you hadn't recognized, if you see that crashes follow predictable sequences, and if you understand that 2025 mirrors 1929 and 2007, then you have a choice. Ignore the pattern and hope this time is different, or recognize it and position accordingly. The pattern doesn't guarantee a crash, but history has been clear. Late 2026 or 2027, the crash comes. The Great Depression, the 2008 financial crisis, and soon, the 2026 crash. 3 times. Same pattern, same sequence, same wealth transfer. The only question is whether you'll see it coming or learn the pattern the hard way. History is clear. Those who understand the pattern survive and profit. Those who ignore it lose everything. The setup is complete. The pattern is repeating. The crash is coming. What you do with this information will determine which side of the wealth transfer you're on.